Yesterday at Mansion House, Lord Mayor Alastair King launched the Scale-Up Showcase with considerable fanfare. 21 promising UK tech companies pitched to an audience of 300 investors. Representatives from Lloyds Banking Group, London Stock Exchange Group, and Aviva filled the room. The same week, Wise confirmed its New York listing plans. Shein announced it was eyeing Hong Kong for its IPO. Cobalt Holdings had already shelved its London offering entirely. The irony becomes apparent. The UK currently ranks third globally for tech startups and innovation. Only the United States and China surpass Britain in this metric. Yet our most promising companies consistently choose to scale abroad when growth accelerates. The Scale-Up Showcase attempts to address what officials call the funding gap between £2 and £20 million. But these numbers expose a complete misreading of venture capital dynamics. Companies seeking £2 million are still in startup phase, not scaling. Companies requiring $20 million have typically already decided their geographic destiny, and increasingly that destiny lies across the Atlantic. The pension fund angle adds another layer of complexity. Recent regulatory changes freed up institutional capital for innovation investment. Pension funds operate on decades-long investment horizons with predictable return expectations. Venture capital demands patient money that can absorb complete losses. No amount of networking bridges this inherent mismatch. Kirsty Rudder from Lloyds spoke enthusiastically about becoming the best bank for fintechs. The bank's actual track record in leading significant fintech funding rounds tells a different story. When Aviva last wrote a substantial check that kept a unicorn in London remains unclear. These institutions have watched company after company relocate for growth capital. The regulatory environment compounds these challenges. Brexit promised streamlined rules and regulatory flexibility. Instead, additional compliance layers emerged while competitors simplified their frameworks. Delaware incorporation remains more straightforward than navigating British corporate structures. European regulations around venture investments continue tightening rather than loosening. The Citi Corporation launched its SME strategy last year with comprehensive promises. Enhanced visibility for small businesses was highlighted. Unlocking the city's networks received emphasis. Developing support for early growth companies made the agenda. Yet capital allocation inefficiencies persist unchanged. The talent migration pattern proves equally troubling. When senior executives from companies like Revolut relocate to New York, they access deeper talent pools. Advisory networks there operate with greater sophistication. Client conversations involve billions rather than millions. British universities continue producing world-class graduates, but the financial ecosystem scaling stays constrained. Timing makes this showcase particularly questionable. Global venture funding has contracted significantly over the past 18 months. American funds have become increasingly selective about their investments. European tech valuations remain compressed compared to pre-2022 levels. Bringing together traditional UK investors with ambitious tech companies during this environment creates unrealistic expectations. The mathematics of venture capital scaling expose the core problem. UK institutional investors typically write smaller checks than their American counterparts. They demand more conservative growth trajectories from portfolio companies. Strategic value beyond pure capital proves limited in the domestic market. A fintech company choosing between a London Series B at 15 million and a New York Series B at 50 million faces an obvious decision. Access to American customer bases creates additional advantages. Deeper talent pools expand opportunities. More sophisticated exit markets complete the package. London's value proposition weakens further with each comparison. The companies presenting at yesterday's showcase understand these dynamics perfectly. They participate in these events while simultaneously preparing American expansion plans. Previous initiatives followed identical patterns. The British Business Bank launched with similar promises. Various tax incentive schemes were introduced and promoted. Multiple Lord Mayor events have been organized over the years. Each addressed peripheral symptoms while core structural issues remained untouched. Ian Merricks from VenturePath noted record low graduation rates from startup to scale-up phase in the UK. This observation cuts to the heart of the problem. British companies excel at innovation and early-stage development. The scaling phase consistently drives them elsewhere. The scale-up showcase represents well-intentioned policy theater. Until fundamental regulatory, economic, and cultural barriers receive genuine attention, networking events remain cosmetic solutions. The 21 companies that pitched yesterday deserve systematic reforms, not symbolic gestures. Whether London delivers those reforms will determine if next year's showcase features the same companies or their American subsidiaries.